Welcome to this webinar in a series on helping you navigate the resources and various options available to you as an operator, primarily focusing on recent legislation. This webinar today will focus on providing updates and answering questions submitted from viewers of the initial webinar. This webinar is brought to you by Performance Food Group to provide you with ideas and resources to help you in this time of industry distress. The initial webinar and other resources can be found on Performance Food Group's website under COVID-19 Resources for Operators. Next. This page contains certain disclaimers. Please review. In addition to the legal disclaimer provided, as you're aware, we're in a very fluid and ever-changing environment. We will be providing the most up-to-date information available as of today. As regulations and implementation guidance is finalized, certain information presented today may change or be further clarified in the future. Next. Today's agenda will be focusing on answers to questions from the prior webinar in the area of overall market trends, employment-related legislation, and loans and grants available to operators, primarily focused on the SBA. The panel today is hosted by me, Keith Middleton. I currently serve as the co-managing partner of Fahrenheit Advisors, overseeing our consulting and fractional financial management practices. Fahrenheit is an advisory and search firm primarily serving the middle market, focused on business strategy, finance and accounting, and human capital. Joining me today is Nathan Douay, a managing director in our human capital practice. Nathan served as a human resources leader in the food service distribution industry for over 17 years and now serves middle market companies. Doug Jones is a managing director in our business advisory and fractional CFO practice. Doug has over 35 years of providing CFO services to middle market companies, including franchise QSR and fast casual operations. Let me add that all of us have deep industry roots and currently serve operators. We feel what you are going through, and you are all in our thoughts. Next. We'll kick off some, go back one, sorry. We will kick off some high-level questions and thoughts on what we are seeing and experiencing in the market. First, how is the market going, and when will it be back to normal? How is it going? Not good. When back to normal, who knows? I think the real answer depends on your geography, the industry, and within the restaurant industry, the specific concept of takeout or white tablecloth or fast casual, etc. In Virginia and other markets, we are seeing what is the new normal being set. And operators and small businesses are starting to set into that is the foreseeable future, especially as stay-at-home orders get extended. Many companies are spending a lot of time on the what's next. What is strategy? How do I pivot? What does my business look like coming out of this into the future? And what is and will disrupt business in the future? And how can I apply that to my own business and concept? Secondly, once we get the PP loan and to the other side of this, when and what that looks like, who knows? But in the meantime, what should companies be doing now and thinking about in the future on how to manage their funds? What should they prioritize? As talked about in the last webinar, continuing to focus on liquidity, cash management, and good cash flow forecasting capabilities will be key over the next 2 to 3 months before the PP money comes in, if you do get the PPP money or other loans, and then what happens after the 8 weeks. Companies should be spending their time around liquidity, cash management, and cash flow forecasting, if nothing else. And the third, in the overall market, the question was asked, what changes are we making as a company? As it relates to Fahrenheit, I'll call it the 4 S's. Stopped, non-essential. So we looked at our costs and stopped non-essential costs across the board, as small as the daily newspaper to janitorial services to other related items. Scaled back non-performing assets. We looked across our business and started to scale back those resources that the market was not buying and may not buy in the future, specifically as it relates to search and certain systems consulting projects. Starting to pivot to what the market is asking for now. In our business, interim and fractional part-time resources are being called upon to fill in where companies aren't rehiring, help with loan application and forgiveness calculations, and other grant and loan items. And then lastly, strategizing and getting ready for what is next. Looking at where the business is going, what business will our clients need coming out of this in specific areas of part-time help, as well as distressed financial consulting. Next. Now we'll turn to updates and new information that are more related to human resources. Next. So Nathan, big picture, what are you seeing in the market as it relates to employers and employees and any trends that you're seeing, or is it just depends?
Obviously, it depends a little bit on the company itself, but some of the things we're starting to see is that, and this first one's a little surprising, and in a good way, is that employees, the leave request that they are requesting and taking has not been the burden on employers that we had feared initially. So it seems as though it's going along well, and employers are able to not only accommodate the leaves, but employees have been very careful in how they are requesting and taking their leave. So that's a good thing. The second thing is, employers are already beginning to think about the challenges that they're going to encounter when they start to return to normal or at least near normal operations. They're thinking about getting employees back to speed and how the schedule will work, and some of their biggest concerns around their responsibilities to employees when they do get them back to work. So that's I would guess, the second thing. And thirdly, I would say that employees have done a very good job of holding on, meaning they're keeping their operations viable. They're working with their employees and keeping them involved with the operations. They've scaled back. They've done different things to keep their business going. But what I'm hearing is that it's been a struggle, and if the lockdown continues much longer, if it continues into middle May or maybe late May, we should expect to see more drastic actions becoming necessary. So they're holding on, doing a good job, but it is something that time is not on their side, and if things do not kind of loosen up a little bit for them, they will need to take or consider some of these more drastic actions. Next.
So in your role as kind of a human resources consultant around, especially around this legislation, what are the most common questions that you're getting on a daily basis?
Well, I mean, it goes with where the company is in terms of their situation. But, they're starting to ask questions like, what do I do, if an employee comes forward, they're working a normal shift, but they come forward and tell us they're not feeling well or they have a temperature. Obviously, we send them home, but the question is, what should I tell the other employees who have worked with them, and when should I inform them? So that's been a big question. Secondly, the question of medical justification still seems to be out there. How much medical justification can I request when an employee requests leave? And more importantly, when they have taken leave for an illness and come back, how much more medical certifications and requests can I get from them to justify a safe return to work? So that's been the second question. Also, as again, they start to open up their businesses just a little bit, they are asking questions about, should I institute measures such as checking my employees' temperatures or requiring face masks in the workplace? What should I do to not only make my employees safe, but how do I, in fact, live up to OSHA's general duty clause and making sure that I have a safe work environment? And I would say, lastly on that, Keith, is, I think this is on a kind of a case-by-case basis, but it's happened a lot recently, and it's how should I respond to an employee who's been, they have an underlying medical condition, but is not showing any signs. They have, maybe a pulmonary or a lung condition that they've had for years. They're concerned about coming into work and being exposed, and they want to stop working. And unfortunately, the Act does not provide them any benefits whatsoever because they're self-diagnosed. So the question has been, how do we handle those types of questions and how do we handle those types of employees? So those are the general questions I think that we're receiving. And again, it I think talks to or speaks to the fact that the companies are starting to implement the Act's provisions and they're running into these real-life questions. Next.
Yeah, and on those, we will cover a couple of those a little bit later in the Q&A, and then some of those are just company by company specific. It's kind of hard to have them across the board. So the next question that we've got is, as further guidance is being issued related to all this recent legislation, what seems to be the common theme coming from the regulators?
Well, the regulators, I think, are they're being very receptive to the questions they're getting. They're hearing from employers and employees about questions about how to implement the provisions of the Act. And I think what the Department of Labor is trying to do is they're trying to strike the right balance between what employees want as far as access to their benefits, and what the employers need as far as allowing those leaves, accommodating those leaves, but at the same time having the employees they need at work to do what is necessary to keep the company open. So I think they're striving in their guidance to give a fair balance. They're not leaning too heavily one way or the other. There are some things in the guidance that are, kind of favorable to taking leave, while at the same time there are some guidance issues that, make it easier for employers to kind of manage the benefits. So I think it's important for employees to understand the rules that govern the application of these paid time off benefits, keep an eye on the newest developments as they are released, and realize that when the Department of Labor wrote these guidance and these laws, everything always looks good on paper, but when you get it into the real world and it interacts with people who have real concerns and real issues and businesses that have real challenges, there is going to be a constant need for some clarification and some refinement. So I think it's important for employers to keep their eyes on those newest developments and be prepared to act accordingly. Next.
Great. So in the last one, we talked about laying off versus furloughing an employee, and we had a couple of follow-up questions around that. Can you just briefly talk about the difference in a layoff versus a furlough?
Yeah. Okay. Well, I personally think, a furlough is much more pliable to the company. It's a pliable management tool in that it's agile. It can be applied in a lot of different ways. Furloughs can be used for shorter periods of time. It can be used in select areas of your organization where you furlough maybe a part of your marketing department for a period of time. You can selectively implement it. It doesn't have to be across the board, and you can apply it to where maybe the expense right now is not justifying the cost that you're incurring. It's not uncommon for employers to use furloughs on kind of a rotating basis to kind of spread the pain, quote unquote, around a little bit while maintaining, a continuing employment relationship with the employee. During furloughs, benefits generally remain intact. because the term of the furlough is generally shorter. It could be weeks, a couple of weeks, 2 or 3 weeks, as opposed to something more long term than that. So I think furloughs is more of a usable management tool. If the employer feels like I need these short-term temporary cost savings, and I can kind of manage my workforce to make sure that I'm reducing the cost where I need to, but also keeping the employee talent that I have in place to manage the needs of the business at that particular time. When you go to a layoff is more of a long-term kind of a permanent action. Employees are essentially terminated. They're not with you anymore. There's not an anticipated return date. In cases of layoffs when they're used, it's been proven to be more difficult for employers to get employees back. The company cuts ties with them, and in some cases, the employee mentally cuts ties with the employer. So when employers have to go to the extreme of laying people off, I think what they've seen in the past is it's difficult to get them back. And the training that they've invested in that person and the experience that they've developed with the company can be sometimes lost. So layoffs are more of a tool that's used when the company feels like, we're in a situation where we just don't see that light at the end of the tunnel just yet. So in short, Keith, I think furloughs are a shorter term, more applicable, pliable type of approach, and layoffs are more of a permanent approach to the need to cut expenses.
Great.
Okay.
Next. A little bit of a follow-on to that, and so you just dove into kind of the furloughs versus the layoffs, so I think good job on that. But the other option that we're getting asked about is you have the layoff, you have the furlough, those differences versus when to just maybe try to retain and reduce an employee's compensation or hours.
Yeah.
Might be a better answer.
Like I mentioned, it has a lot to do, and I think it's controlled almost exclusively from how the employer views, how the management kind of views their short-term business realities. I mean, are they currently in operation just at a kind of a reduced capacity? Are they completely shut down for the time being? Are they working at somewhat full capacity, but they feel a little bit of the slowdown? And along with that, how long do they see these situations persisting? I mean, how long do they think they're going to continue to happen? So before they decide how they want to attack some cost savings, they really need to kind of think through and do a little predicting as to where they think their business is going to go and where it's going to be. If management sees that light at the end of the tunnel and wants to be in a position where they can reactivate quickly, or they can shift into high gear and get back to what might be considered near normal at least, then they're more likely to choose some of these short-term options, such as reduction in hours or furloughs to control some of their short-term costs. If, on the other hand, the management feels like business interruption will have more of a long-term or even permanent impact on the business, then it's likely that they're going to go for the longer-term, reductions in costs, such as reductions in pay or in layoffs. So, in either case, it's a real delicate balance. And what must be done in the short term versus being able to retain a trained and motivated workforce for when ultimately we do return to normal business. So I think management, must consider their options carefully and try to remain as agile as they possibly can. So a lot of that is not a one-size-fits-all type of thing, Keith. It really depends on where they see their business being and how long they think they'll be in that particular situation.
Great. Okay. A more technical question that came through relates specifically to a nonprofit or any company that is using a third-party contract management services or a PEO type of organization, and are they available for the PPP loans? And so the kind of different answers around that. Very specifically, the SBA came out if you're using independent contractors or a temp agency, the answer is clearly no. But it did come out with a Q&A around if you're using a third-party payroll provider or a PEO, a professional employer organization. And the answer to that is yes. The SBA recognized that eligible borrowers that use PEOs can get the amount of wages and payroll taxes reported by the PEO and use that in their loan documentation. The only caveat to that is when you're working with your third party, either you can use it in your loan calculation and document, or they can use those payroll costs in theirs, and you can't both parties do that. So the short answer is for a third party PEO, yes. But it will come down to the facts and circumstances. Next. So a couple of quick guidance updates related to recent legislation, specific with the unemployment guidance under the Pandemic Unemployment Assistance Act. The latest guidance continues to change in assessing unemployment benefits, and they changed it in two important ways. Can you elaborate on what those two things were?
Sure. You know, just like I think what the Department of Labor is looking at is, obviously, I think this morning we saw an additional 5.6 million people file for unemployment over the last couple of weeks, and anybody who's worked with unemployment over the years realizes that in most states, when they apply unemployment compensation, it has a lot to do with what the unemployment arm of the state government feels like is it viable for that person to go out and get another job. In other words, if the market is good and jobs are plentiful, a person applying for unemployment it's going to be tough to get because they know you can go out and find another job. But in these situations, in this situation that we find ourselves today, they know that it's difficult to impossible for people to find other work. So I think what they're doing is they're making it easier for people to access it. And as you mentioned, there's two primary changes that they've made. And the first one being, you know, the $600 added per week unemployment resources that the federal government has made is now being applied to any person who gets any kind of unemployment benefit. In the past, I mean, you know, part-time employees who have been, you know, kind of working on a very short scale, maybe 10, 15 hours a week, if they got laid off, they may have had some unemployment benefits available to them. But what they're saying now is that that person receives as little as $1 of state unemployment benefits, they will be eligible for the $600 additional federal unemployment amount. So they would make no less than $601 per week. So that's a big change. The second big change, I think, is in most states, and again, this is a state-by-state thing, you must work at least 5 quarters in order to qualify to receive unemployment benefits. And I think in most cases, that's for states to make sure that they've had enough work to be able to receive enough tax income to justify paying the benefits. But that 5-quarter, you know, earning requirement has been waived. So a person who works for as little as 2, 3, or 4 months can qualify for maybe minimal unemployment benefits, but as I mentioned earlier, would also be eligible for that $600 federal unemployment insurance benefit payment too. So they're easing it a little bit for people to get the unemployment benefits, and I think those are the two main ways they're doing that.
Okay. All right. Under the next one, this is just for everyone to know that there's a lot of DOL and other regulations that have been coming out under the Family First Coronavirus Response Act, both with DOL enforcement and other guidelines. And just from a time perspective, we will defer those discussion to a future webinar. But in the meantime, you can go to the PFG website, as I talked about, and the links to the DOL and the Act are there, including the guidance. So we're going to move on next to to Doug with loans and grants update, talking about mostly some of the SBA stuff and other things that are going on. So, Doug, the first one is, what's the status of the Paycheck Protection Program that we'll call the PPP loans, and the status changed as of this morning? And so if you want to kick off with that.
That's right. As of this morning, April 16th, it was announced that the funding for the PP program has hit its limit. And we understand that if a company has an SBA loan number, it will get funded. If they do not have an SBA loan number, it will not get funded until and unless Congress approves more money. And supposedly, as we speak, there are conversations going on in Congress about that right now. I will point out that just because you don't know you have a loan number doesn't mean you don't have it. You may well have an SBA loan number assigned to your loan, which means you'll be funded, but it has not yet been communicated to you. So we'll hope there'll be more money. Big picture, there's been 1.5 million applications, over 4,800 banks, and they've used up all $349 billion in the program. Next.
So if you haven't applied, the banks are saying you still can. We're assuming Congress will fund more money. What are you seeing in the marketplace and the companies or experiences related to the applications that were submitted, the process, and the loans that are being funded?
Yeah, I would say it's generally, for a while at least, it looked like the earliest applications were the ones getting funded. That tended to break down a little bit this week as some loans had questions and problems that had to be worked through. But as a general statement, I would say that we've seen smaller community banks making faster progress than the large banks. We had a lot of frustration with large bank customers with complex process, lack of communication. There was a theory floated around that the SBA had focused on funding smaller community banks first, since they have been seen as the most important link to small business, and they have a lot of SBA volume historically. But that said, I've seen funding done by larger banks this week as well. Each application process and approval process depends on the bank. Each one has its different process. They are all still overwhelmed with volume. Some took only a few days to process, and others have still not been processed by the bank in almost 2 weeks. One bank was quoted as saying they had 8,000 applications, 6,000 were SBA approved, 1,000 had issues, and 1,000 were still being processed by the bank. So this is massive volume in a short amount of time, and quite a stress being put on all systems and people involved. Next.
Yeah, so for those companies that haven't applied, what are the 2 to 3 things that they should focus on, kind of lessons that we've learned?
Yeah, well, number one is to try to work with your current bank if at all possible. If they're not involved in the SBA program, the SBA website has a searchable listing of all approved SBA lenders, but it will be a lot easier to work with someone who knows you if you can possibly do that. If you use another bank, you're probably going to have to open an account with that bank and probably promise to move some of your business banking there when this is all done. The guidance for the loan calculation is pretty specific and pretty straightforward. The application has become more straightforward throughout the process. So follow what your bank tells you to do and how they want it done. Each bank is different. And I can tell you, even though we've heard that the money has run out, if you haven't applied yet, I would absolutely apply with your bank. They can't submit it to the SBA yet, but assuming that more money comes into place, you want your application to be ready to go for that second batch.
Great.
Next.
We've heard a lot through all of this process of I was approved, and some clarity around what does approve actually have to mean for you to know you're getting your PPP money?
Yeah, there's been a lot of confusion over the last week or so. People were saying their bank had approved them, and that just meant that the bank had approved the application to go on to the SBA. Other people were using approved to mean the SBA had approved it. And as I mentioned earlier, the key is getting that SBA loan number. That means you've been approved all the way up through your bank, through the SBA, and the funds should be in your bank within 10 days, and sometimes I've seen it happen as quickly as 2 days. So don't get caught up in the technology of what's approved and what's not. Focus on, do you have an SBA loan number?
Great. We're going to do a separate webinar upcoming on the specific loan forgiveness provisions, but especially as additional guidance is going to be coming out. But in the meantime, as companies are getting loans or preparing to get their loans, what are some key things they should be focusing on sooner versus later?
Yeah, and as you mentioned, and Keith, you and I have spent a lot of time on this, the law has a lot of confusing contradictory language in terms of understanding exactly how forgiveness is going to work, including some technical drafting errors. So I would suggest that people not tend to get caught up in reading through every word of the act because they'll end up confused. Big picture, the things that companies need to focus on first is make sure they're using 75% of the loan proceeds on payroll-related costs. The payroll costs as defined in the application and the instructions, 75% on that. Then the rest, no more than 25% of the loan proceeds on interest on mortgage obligations, rent, and utilities. Then the next thing is to focus on ways to keep from getting your forgiveness reduced. So you'll want to maintain your full-time employment levels as compared to prior periods as is defined in the Act, which may even require you rehiring employees. That's a specific thing to look at on a case-by-case basis, but it might be in your best interest to actually bring people back. And then you also want to maintain compensation levels to at least 75% of prior compensation, which if you've made cuts larger than that, again, it might in your particular case make sense to reinstate some of those. Again, we're looking for more guidance. There's been a lot of questions about how do I treat bonuses, how do I treat reduction in hours when the person has the same hourly rate. We just don't know the answers to all of that yet.
Great.
Next.
Okay, so moving beyond the PPP, as more guidance will be coming, what's the current status of the Economic Injury Disaster Loan Program?
Yeah, the EIDL is an absolute mess. The loan volume totally overwhelmed the SBA. You may recall these were the loans that went directly to the SBA, not through commercial banks. There's a notice on the SBA website saying they're no longer taking applications, they're out of funding. Without more government funding, the program has ended. Grants were only being made up to $30,000 with initial distributions being capped at $10,000 to $15,000, which is a far cry from the original communications, which said the loans could be up to $2 million. So there are a lot of disappointed people. Most have seen nothing. Some have seen $10,000 to $15,000.
Yeah. Okay. And then the last question, we've talked about PPP, we've talked about the EIDL and the status of those loan programs. What are some other programs out there for small businesses and operators and things that might be on the horizon?
Yeah, there are a few. The first is, and many operators have existing SBA loans from before the COVID-19 days. There are a variety of programs that both forgive and defer payments on those loans, depending on the type of loan you have. So the specifics may differ in your case. But if you do have an existing SBA loan, contact your bank immediately. They may be able to give you specifics on exactly what provisions are applicable to your type of loan. Then the SBA announced last week an Express Bridge Loan Pilot Program. excuse me, supposing allowing businesses to get up to 25,000 quickly while awaiting their EIDL, which we now know is not coming. You need to have a relationship with an SBA Express lender. Check with your bank to see if they are one. Everyone was so focused on PPP last week, this program received little attention. And I don't know if it's going to run into the same funding problems. But if I were a small operator with a relationship with an SBA Express lender, I would certainly look into that as soon as possible. The final option is one that was announced last week by the Treasury and Federal Reserve, and this is mostly intended for larger operators. It's called the Main Street Loan Facility Program. It's a $600 billion program intended for businesses with up to 10,000 employees. So clearly this would be something for larger, not smaller operators. The details are still coming out, but while the funds appear to be intended primarily for companies that are too large for SBA funding, there's no prohibition against smaller companies applying, even if they've applied for PPP loans. We do see that there's a minimum loan size of $1 million, so this would not be a vehicle for our very small operators. It's an unsecured loan with variable rates in the 2.75% area, 4-year maturity with principal and interest deferred for 1 year. There's some other restrictions on that. Again, we're hoping to see more guidance on that, but other than the original announcement of the program last week, we haven't seen more specifics, which I was hoping we would see this week, but we have not seen yet. And with that, I'm going to turn it back to Keith.
Great. From a resources perspective, there is further information and details on today's subjects and others on PFG's website, as well as Fahrenheit's Insights webpage, where we post new information daily. You'll receive a webinar survey so you can provide feedback and also ask additional questions. So with that, thank you for your time and stay healthy.